fund play the role in the market. They basically find opportunities to profit from inefficient market positioning or pricing. Right? So they have different strategies. And the private equity, different type of funds, they basically look to take invest in companies and either take them private or invest in the private equity form to hopefully improve the company's profitability and then cash out. And governments obviously have a huge impact on the market. So we know in the financial crisis, government intervened. And not only that, at the normal market condition, government always have a very large impact on the market because they are the policymakers. They decide the interest rate and the interest rate curve, and the different policies they push out obviously will generate different outlook for the future markets, therefore profitability. Then the corporate hedges and the liabilities. When corporates borrow money, they create some risk, so they need to be sensitive to the market changes. So to summarize the types of trading, the first type is really just hedging. That means you're not proactively adding risk to what you have. You already have some exposure. Let's say, just give you an example. Let's say you borrow money, you bought a house, so you have a mortgage, and so let's say it's floating rate mortgage payments, and you're worried about the interest rate going higher, right? So you can lock that rate into the fixed rate format, or you can find ways to hedge your exposure, or your corporate has a large income coming from Europe, so you have euros coming in, but you're not sure if euro will trade stronger to the US dollar in the future or trade weaker, right? If you think it will be stronger, you just leave it. But if you think it will trade weaker, so you may want to hedge it, meaning you want to sell euro and buy US dollars. And so that's the hedging type. The second type, as I mentioned, is a market maker. So market maker also takes principal risk, but the main source of profit is really to earn the bid offer. I gave you the example of 90 cents bid, 95 cents offer. So that's what the market maker is trying to profit from. But obviously, they have residual risks sitting on the book. Not every trade is matched. So how to optimize those group of trades, that's what market maker is doing. Most of the banks, dealers are market makers. In the new regulation, obviously, proprietary trading is is banned, right? And so the third type is really the proprietary trader, the risk taker. So these are the hedge funds or some portfolio managers. They need to focus on generating return and with controlled risk. So that's where the beta and alpha, the concept comes in. So if you're a portfolio manager, some people say you don't really, don't worry, don't go pick any stocks, just buy S&P 500 index fund, very cheap. You can pay very little cost to do it. That's true. So, but if you want to beat the S&P 500 index, let's assume we call it S&P 500 index fund is asset B. So the return of that, R of B, that's the return of that index. Then you have a portfolio A. You time series of return of your asset A. Obviously, you can do linear regression. Right? A lot of you are math major here, and you can find a correlation between those two time series. So how the two returns are related in a simplified form. So you can say this actually somehow it came out. It's supposed to be alpha and a beta, but it turned out to be the letters. But so in a short description, beta is really kind of just think as the correlated move with the other asset. Alpha is really the difference. In return, format, you want to beat S&P 500. So you want to basically have certain tracking of this index, but you want to return more on top of that. So let me just go in bit details of how each type of trade actually occurs. So when we talk about hedging, I mentioned the currency example. Let me give you another example. There are a lot of people issue bonds or issue debt. So this example I'm going to give you is, let's think about Australian corporate, because interest rate in Australia is higher than in Japan. So typically people like to borrow money in Japan because you pay smaller interest, and invest it in Australia, you earn higher interest rate. So let me ask you a question. Who can tell me, why don't people just do that all day long? Just borrow from Japan and invest it in Australia. Then that interest rate, I'm giving you an example of a difference is about 3.5% for the 10-year, roughly, 10-year swap rates. Why don't, go ahead.
You exchange the exchange rate back.
Right. Because you invest in the Australian Aussie, right, Australian dollar. The Australian dollar may become weaker to the yen. You may lose all your profit or even more, right? And further, if everybody plays the same game, then when you try to exit, you have the adverse impact of your trade. So let's say you think that's the right time to do it, but then at one time you wake up, you said, I think too many people are doing this. I want to hedge myself. So what do you do? Yep. So you try to lock in, right? So basically you sell the Australian dollars, buy the Japanese yen. Or on the interest rate terms, you say you basically pay the Australian dollar in the swap leg and receive yen. So that this involves foreign exchange trade, interest rate swap, and the cross-currency swap. So your answer about currency forward is roughly right, but it obviously involves a bit more in actual execution. So that's just give you an example. Even you are not a finance guy, you work in a corporate, you just do import, export, or building a factory, or you have to know actually what the exposure is. So risk management nowadays becomes pretty widespread responsibility. It's not just the corporate treasury's responsibility. So that's on the hedging side. Obviously, if you're Intel, for example, right, you sell a lot of chips overseas, and your income, actually Intel does have a lot of overseas income sitting outside the States. So the exposure to them is, if the exchange rate fluctuates, dollar becomes a lot stronger, they actually lose money. So they need to think about how to hedge the revenue produced overseas. And obviously, if you are import exporters, that's even more apparent. And if you're entering in a merger deal, one company is buying another, you need to hedge your potential currency exposure and your interest rate exposure, and whatever is on the assets or the liability or the balance sheet, you need to hedge your exposure. So we talk about hedging activity. Let's talk about a bit of market making. So if it's a simple, transparent product, everybody pretty much knows where the price is, right? So if you buy Apple stock, I think a lot of people know pretty much where it is. You may even have it on your cell phone, right? Know where that stock is. But if it's not transparent, so what do? So if instead of asking you where Apple is, probably you're going to tell me $4.95 today? I don't know. Okay. Yeah, but if I ask you instead, what is the call option on Apple stock in 2 months' time? I'll give you a strike, let's say 500. Right, so you're probably less transparent. So that market maker comes in to provide that liquidity, and then takes the risk, then manage the book by balancing those Greeks, which I mentioned earlier, delta, which describes